welcome to the 4 o'clock work session of the Douglas County Commission for April 2nd, 2025. This afternoon, we are having a work session and staff's going to provide a review of generally accepted accounting principles, sometimes called GAAP, and the regulatory cash-based methods of accounting and reporting. Just a reminder that our work sessions are for informational purposes only. We don't take any votes at our work sessions. We also don't take any public comment. If you'd like to provide public comment, you're welcome to join us at our 5:30 business meeting and provide your comment during the public comment period. And with that, I'll turn it over to Brooke Sauer, our finance manager, to get the presentation started.
Thank you, Commissioner Kellys, and good afternoon. Brooke Sauer, Finance Manager. Staff is extremely excited to kick off this conversation about the different reporting frameworks that the county can use to report our financial data. To start the conversation, I would like to introduce some folks with Eide Bailly. Staff reached out to them and asked their team to present some of the differences between a GAAP reporting framework versus a cash basis or regulatory method, and what some of the advantages and disadvantages of both methods are. At this time, I'd like to turn the presentation over to Brian Stavinger and Jerry Bowes with Eide Bailly to discuss the two methods of accounting in greater detail. Jerry?
Okay, thank you, Brooke. We greatly appreciate it. I think Brian is having maybe some technical issues, so we planned for this just in case. I believe you had indicated that you wanted this limited to roughly about, what, 2 hours? Oh, there you are, Brian.
Hi.
No, obviously, that would be torture if we were to go through this for 2 hours. So we're going to leave it to the basics. Brian, you want to get us started off?
I sure can. Just a quick clarification question. Brooke, do you want us to share our presentation through this medium, or is that something that you've got pulled up already?
Yeah, Brian, you can go ahead and share your screen. I also have your presentation pulled up, and I can share it and advance the slides for you if you'd like, whatever you prefer.
Yeah, let me just quick get this set up. Apologies. All right, let's share and just get a verbal yes. Looks good. I can see it.
We can see it, Brian. Thank you.
Okay, wonderful. So thank you for having Jerry and I. We appreciate the opportunity to kick this off. We will try to keep our session more brief so that Brooke can also share some more specific items to the county itself and the potential pros and cons of converting to a different basis of accounting. So at a high level, really it's already been described as such, really regulatory or cash basis. Jerry will get into the details of that, but it's pretty simple. If any of you still use a checkbook, the way that cash basis works is literally whatever goes in or out of that checkbook or in or out of a bank account is what's recorded and reported on your financial statements. Full GASB GAAP is much different and more robust. Jerry will get into those details. Just want to give you a little bit of background on myself, and then Jerry will introduce himself and he will get going on the slides. Brian Stavinger, a partner with Eide Bailly, been here for 25 years. I'm actually located in Fargo, North Dakota, where we have a fun April snowstorm dropping half a foot of snow on us. Hopefully it'll melt in the next day or two, but that's what we're enjoying. I've worked with local governments my entire career and have worked on both cash basis type engagements as well as full GASB GAAP. So I've kind of seen it all. I'm happy that Brooke and her team reached out to Jerry and I to see how we can help with this discussion. So I will turn it over to Jerry to introduce himself, and then he can get going on the topic.
Okay, thank you, Brian. I'm Jerry Bowes. Been with Eide Bailly now since May of last year. Prior to that, I retired from the Tennessee State Auditor's Office after almost 30 years of service. So my focus is typically on state government and from an auditor perspective. However, I am now a recovering auditor and serve as a director in our Government Advisory Services department. And so part of that is Obviously all things GASB. And so that's what we're obviously going to try to get into today. So before I get into the details, what I'd like to do is just kind of establish a foundation here. When we think about accounting and financial reporting, we can especially go into a GASB gap. One of the things that GASB established way back in 1984 was part of what they consider their conceptual framework. Part of that foundation is built on two concepts: accountability and interperiod equity. Accountability is referring to governments being held accountable by the public and ensuring that resources are used efficiently and effectively. Interperiod equity is ensuring that the cost of services are borne by the taxpayers who are going to benefit from those services, rather than shifting that burden to future taxpayers. So from that perspective, when we think about the spectrum of the different accounting bases, we go from, like Brian said, the pure cash basis at one end of the spectrum, short term, focus strictly on cash inflows and cash outflows. Really difficult to see a comprehensive view of the financial health of your government. Whereas on the complete opposite end is GAAP, which is full accrual GASB GAAP. And also within that is simple versus complex. And so we'll talk more about that. But when we think about the differences between the different bases of accounting, we think about first, okay, what do we want to recognize and when do we want to recognize it? And that's where we get into when we talk about these differences between the different measurement focuses and bases of accounting. So when we want to figure out what to recognize, we're talking about the measurement focus. That is current financial resources measurement focus and economic resources measurement focus. Current financial resources are going to include only those current assets and liabilities focused again on short-term financial resources. So we're talking only the next year or 1 year or less. So yes, cash basis, modified cash, even modified accrual. All of those are on that spectrum. And I would say cash, then modified cash, then modified accrual. Then it's, okay, well, when do we recognize it? And that's the basis of accounting. And that's your cash basis, your modified cash, your modified accrual, and your full accrual. And that is just basically the timing of when we're going to recognize transactions or events. So that really, in a nutshell, describes the differences of each of those different options that you have. And it's when you go to the next slide, this is just a pictorial of what this all looks like. Obviously, the full accrual basis is not on here, but that would be on here as well to kind of give you the full range of the spectrum. The difference when you're going from where you are now to going full accrual and GAAP is that not only do you have for governmental funds this modified accrual basis of accounting, you're focused on current financial resources. So you're not going to be recognizing any long-term transactions in the financial statements. But when you get to full accrual, you're recognizing everything. It's a comprehensive view of all the events and transactions that happen in your government. So what benefit does that have? As we go to the next slide, when you're thinking about, do we stay where we are because we're simple. We don't have any complex transactions other than maybe bond issuance of public available bonds, which would be considered a complex transaction. But other than that, you don't have really anything that's complex. So when you use cash basis, it really is usually based on the simplicity of your operations and so forth. When you're making decisions, you have that short-term focus in mind. And typically we think about short-term focus again as 12 months or less. However, when you think cash equivalents, that's a 90-day or less period of time, or what we consider near term. The cons to this, as you see here, is really the amount of information that you are able to use for decision making and what that short-term decision making impact has on long-term outcomes. So you do get an incomplete picture. However, there are, as we always say, it always comes down to cost benefit. So as we move on to the next slide, which is going to be, full on riding the bull here, and hope you can stay on for 8 seconds. You do get a comprehensive view when you look at GASB GAAP. And this is within GASB GAAP. When you go full on GASB GAAP, you have both the full accrual for most of your financial statements and then modified accrual for your governmental funds. But everything else other than governmental funds is full accrual. And so that does make a difference. But with both of those different features, you do get a comprehensive view. But if you only had just the government-wide view, then you would not be able to get that full comprehensive view from just the governmental funds. Again, because it's a current financial resources focus, meaning only out 12 months from the balance sheet date, for instance. With this comprehensive view, you do get a better sense of regulatory compliance. It is a little more, it is more consistent because you have authoritative GAAP or authoritative guidance that guides you through the process. Again, you get consistency. And one thing that we have found that is a consideration, especially if you issue bonds like you all do, is whether or not the bond analyst, for instance, view non-GAAP financials as a negative or not. And there could be variables within that would lead to that decision. One reason why they may not look at it negatively if you're doing non-GAAP is because, like you all have, you have a debt service fund where you're accumulating resources to pay that debt. So you have sufficient cash balances or cash equivalent balances or investments that are strictly dedicated to paying off that debt. Well, if a bond analyst from your financials can see that that's there, they may not look negatively on it not being GAAP-based financials because they're confident that you have the resources available to meet obligations as they come due. However, if you didn't have that, then most bond analysts would look at it as a negative, not having GAAP financials, because what else is not included in that picture? Everything else that's long term, pensions, OPEB, compensated absences, all of those types of long-term liabilities are not included in that comprehensive decision-making process, at least that the external users can see. So there are some cons to not using GAAP, but again, there's also some cons to using it. It is very complex. But it's complex for a reason. It's usually because governments have complex events or transactions. It's not necessarily the GAAP that is complex. It's the transactions that we as governments have that make it complex. And then it is going to be resource intensive, especially the first couple of years of going through the transition. but over time that does get easier to handle. Let's see, go to the next. And so, like I mentioned, most of the financial statements are going to be using the economic resources and full accrual basis of accounting, except the governmental funds. Everything else, government-wide, proprietary, et cetera, are going to use this. Governmental funds themselves, current financial resources, modified accrual basis of accounting. It's closer to the full accrual than it is the opposite side of cash. So in other words, it's going to include most transactions and events except for long-term assets and long-term liabilities. Where that gets captured at the full GASB gap is at the government-wide financial statements. So as you're hearing me say this, you can tell that there are multiple levels of financial statements that are going to be in addition to what you do now. And then, so when would you use each? GASB gap, typically larger entities, or when there are certain regulatory requirements that you need to meet. A lot of times what happens there are external requirements, such as in bond documents that require a gap basis sometimes. And if that's the case, or from a federal financial assistance standpoint, it may be required from a single audit standpoint. And then cash, simply what you're doing now. You don't have complex transactions. You don't issue publicly available debt. You don't have derivatives transactions or anything like that. So advanced kind of investments. When you don't have those things, then certainly cash basis is perfectly acceptable as long as you're able to provide your constituents, your citizens, the essential information that they need to make decisions for whatever reason. And you internally can make those decisions as well. That allows you to determine your fiscal health, your financial health, and fiscal sustainability over time. That really is what it boils down to in a nutshell. But then from, I would say, a county commission standpoint, just some of the things that you will want to consider is ultimately the big decision that you all have to make, and what level of information is essential for your decision making in assessing the long-term financial health of your governmental entity. Does a short-term focus on cash flows provide you the level of information to properly inform your citizens to hold the government accountable? Do bond rating agencies, for the times you issue publicly available debt, view non-GAAP financial statements unfavorably? If you have a substantial emergency fund or a rainy day fund to address any doubts about your ability to meet your obligations as they come due, then GAAP-based financials might not be important. However, do you otherwise assess the financial health of your government without having a comprehensive information about both short-term and long-term events and transactions? And in the end, the decision comes down to an unbiased, objective cost-benefit analysis and considering the pros and cons of transitioning to GAAP-based financial statements or maintaining the status quo. And finally, just one other tidbit that I always indicate in various settings is we're able to do in GAAP based financials is you can identify the impact your short-term decisions have on your long-term fiscal health. Whereas if you are using cash basis or a variation of that, sometimes that is difficult to determine the impact of those short-term decisions on long-term fiscal sustainability and financial health. So with that, Brian, I'll turn it over to you for any further analysis, and then we can take any questions that you all might have. Because I know that was a lot of information.
Yeah, thank you, Jerry. I should have pointed out there is a lot of information on these slides. It was not our intent to, and we did not go word for word through it. It's also meant to be a resource as you walk away from this meeting to read through it, continue to take in all the information, probably generate more questions, but we wanted to get you as much as we could on each slide for that reason. I will say, Jerry mentioned regulatory requirements. Another big regulatory requirement would be at the state level. I know in the state of Kansas, they allow you the opportunity to select between the regulatory or cash basis versus the full GASB gap. That is not the case in a lot of states. A lot of states just require full GASB gap. In fact, the state of North Dakota had a similar allowance at the county level for many, many years, where counties could report on either cash basis or GASB gap. They are transitioning over the next couple of years to requiring all counties to go full GASB gap, which is causing a lot of challenges when it comes to finding the resources, time, qualified personnel to be able to make those conversions, not only in year one, but also year two and thereafter. So it's a bit unique, state by state on what each one allows. And I will say Kansas is putting you in that unique situation where you do have the opportunity to continue to choose between one or the other. So with that, we'll entertain questions or just turn it over to Brooke. I know Brooke's got plenty of information to share as well. And Jerry and I will hang on the call as well if there's questions later on.
Brian, Jerry, thank you so much. If I may have you stop sharing your screen. And Brian, thank you. That actually tees off perfectly into the next presentation. But while I'm working to share my slides, commissioners, I want to open up this opportunity for you guys to ask any questions of Brian and his team while we've got them, while I am pulling up my presentation.
Yeah, Brian, this is Gene Dorsey or Jerry, either one. Could one of you define government funds?
Yes, just generally speaking, a governmental fund is an accounting mechanism that is used to accumulate resources and then be able to track those resources because maybe there is a requirement in statute or ordinance or whatever that requires you to have a separate fund. For accounting and financial reporting purposes, though, it doesn't necessarily mean that you have to discretely present every single one of those different funds individually in individual columns. GASB allows for the consolidation of those into fund types. So, for instance, you may have special funds or special revenue funds, and you may have 1,000 of them because, for instance, state law or your own ordinance or resolutions require you to have account for all funds separately. But in reality, those all may be just one fund type, like a special revenue fund that you can roll up into one. Or in accordance with GAAP, they may be major funds and say only a handful of those need to be separately identified, and then all the others can be aggregated into one column. So that kind of gives you just that's a very broad idea of what it is. Brian, anything else you want to add to that?
Yeah, I think maybe also sharing another type of fund. It's got a variety of names, but essentially a business type or proprietary fund.
Mm-hmm.
And that type of fund is generally the revenue stream or revenue sources that fund the operations of that. That single fund would be a charge for service, some sort of user fee. So I'm trying to think. I mean, I've recently worked with like a park district or a water sewer where you're charging for the use of that. If you're a park district and you're charging for the use of renting a soccer field or something, whereas opposed to governmental funds are generally going to be proceeds from bonds that are used to construct some sort of capital project, usually sales tax, property tax, any sort of tax. All of that is reported either in one fund or segregated, as Jerry mentioned. Sometimes it depends on how things are set up, but essentially a governmental fund, usually there's either minimal or no charge for service. It's more tax driven as opposed to the alternative, which is more of a charge for service.
Mhm.
And I think at the
Thank you.
county level, Brooke can correct us. I think for the most part, you have governmental funds, with the exception of maybe one proprietary fund. So most of your reporting is done in that governmental fund framework.
Thank you.
You're welcome.
Thanks, you guys. So commissioners, Brian touched on it briefly about, whether or not states give counties and municipalities, special districts, the choice to choose a different reporting framework. And this is, so the GASB, the Governmental Accounting Standards Boards, recently released a study. And the study reviews the financial reporting framework requirements for both state and local governments. They then evaluate how many agencies choose to adopt the GAAP reporting framework when there is a choice. The two main objectives of this study were to, one, identify the state requirements related to the financial reporting for the state and for local governments, and then to evaluate the determinants of the choice to use GAAP, the GAAP framework, in the absence of a state requirement to follow GAAP. So kind of what Brian was just touching on, the state of South Dakota just imposed that requirement on their local governments to implement that model. This slide details the results from the first objective from the study. They found that 48 of 58 states have a GAAP requirement, but all 50 states do utilize GAAP. The study revealed that while all 50 states do utilize GAAP, GAAP is less commonly prescribed as a financial reporting framework for counties, cities, and special districts than it is for states. 31 of the 48 states require some form of GAAP reporting framework for counties. Connecticut and Rhode Island do not have counties as reporting units of government, which is why there's only 48 states instead of 50 listed. 13 states have no framework specified, but GAAP is optional, and the remaining counties have a non-GAAP requirement. All governmental agencies prior to 1970 required cash basis fund accounting. The next slide details the second objective of the study, and it takes samples of governments in 7 states. What they found is that when states have developed alternative reporting requirements, GAAP utilization is less likely. In the state of Kansas, we have the Kansas Municipal Audit and Accounting Guide, or KMAG. Alternately, governments without developed alternative reporting frameworks are 12 times more likely to use the GAAP framework. Generally, the variables associated with the GAAP utilization are directly associated with total revenue received by the organization and the amount of debt that the agency issues. The determinants of GAAP utilization also revealed that cultural or organizational factors may influence the government's willingness to use the GAAP framework. Governments may conform with accounting principles resembling its peers and adopt policies that are respected by governments and the accounting profession in order to obtain legitimacy. For example, if the organization has a CPA on staff, that organization is more likely to elect the GAAP framework in response to professional coercion rather than political or economic motives. In contrast, GAAP reporting requirements may be imposed by another government in order to exchange resources as a form of institutional pressure to conform to the GAAP reporting model. Lastly, an excerpt from the study revealed that in the state of Illinois, where GAAP is required, but with exceptions, municipalities that issue debt in that state are 2.8 times more likely to utilize the GAAP framework than others. There is a positive perception of GAAP-based financial statements in the debt market, which can result in lower general obligation bond costs. However, the study did note that the disclosure requirements may not be economically efficient and that the cost of gap utilization may outweigh the favorable debt market effects. The statistics listed on this slide detail gap utilization using opinion letters submitted through the U.S. Census Bureau from the annual survey of local governments. Douglas County also participates in this survey. We respond to it every year. 435 counties were polled for this sample, and 74% of those counties utilized gap. Of the samples selected for the actual study, it's estimated that about 1,500 counties have public debt. Of those governments, it's estimated that 75% utilize gap, which is very consistent with the much larger sample size listed on this slide. Ultimately, the factors that increase or decrease gap utilization come down to how much revenue is received, the amount of outstanding debt that the organization has, and whether or not the organization is subject to the single audit requirements, and whether or not gap utilization is required. The likelihood of gap utilization increases with when total revenue, outstanding debt, or whether or not the agency is subject to those single audit requirements. And then gap utilization decreases when alternative frameworks are available. Simply, it's decreased when the organizations have the choice. Commissioners, we're going to get into some more local data on the next few slides. This slide shows the top 10 most populous counties in the state of Kansas, along with the framework used to complete their financial statements. 4 of the counties in the top 10 sampled utilized gap, and they're listed here. There is a clear line that begins with Douglas County for utilization of the cash basis method of accounting. When considering total revenue, Johnson and Sedgwick alone total close to $500 million in taxes levied in their districts. Shawnee County comes in a little over 110 million, followed by Douglas County at 86 million, and then Wyandotte at 73 million. Leavenworth County, which directly follows Douglas County in terms of population, levies around 42 million in ad valorem tax. In terms of debt, Johnson County has the highest value reported at $836 million in bonds issued, followed by Saline County at 70 million. They did just issue debt for a new jail, so that number is very high right now. Douglas County right now has 19 million in issued debt, but that total does not include the $55 million bond series that we will potentially issue early this summer. Similarly to the GASB study, county staff also reviewed auditor opinion letters for the top counties listed on this slide. The table on the left shows the regulatory standards used for each county's auditing firm based on their opinion. You can see 3 regulatory frameworks. The first is generally accepted auditing standards, or GAS, government auditing standards, or GAS. And then the KMAG, the Kansas Municipal Audit and Accounting Guide. You can see that all counties, with the exception of Sedgwick and Wyandotte, have opinions made using the same regulatory standards. The management responsibility does shift significantly with a GAP statement to include the preparation of the financial statements in accordance with GAP, and they're done in-house. From a KMAG perspective, there's still a lot of work that's required it is required to be able to produce the work papers to give to our auditors, but there are existing controls in place which allow this work to be completed throughout the year by end users making transactions in the system. Essentially, our end users, they're doing the work without even knowing it because they're following the standard operating procedures that have been developed by management, and the internal controls are implemented through process and through workflows. Staff reached out to a neighboring county that has their financials reported using the GAP framework. The county that staff reached out to, we feel, is pretty close in terms of budget and perhaps debt. They just do their financials a little bit differently. That finance office does have 6 full-time staff members, but 3 are entirely dedicated to the audit function and preparing the schedule of expenditures of federal awards or the CFA for the single audit. If the county were to add 3 full-time staff members at a base salary of $65,000, the annual expense would total roughly $274,000. The neighboring county did also indicate that most of this work is being completed in May, which runs concurrently with our annual budgeting process. Right now, the field work that is being conducted for our financial statement is being done mid-April, which allows finance staff to quickly pivot into budget. But there's still a little bit of an overlap there. Staff also spoke with a different county that is much, much smaller in size. And in fact, they weren't listed on the top 10. They said that they would have to add 2 full-time equivalents to be able to manage the technical aspects of completing these financial reporting in-house if they were to move to that framework. Staff also learned from one other county who was also not listed on that slide. They didn't have their financials completed yet, but they are GAP compliant. What staff there was able to let me know was that a longtime CPA firm that they had hired to complete this work, the CPA retired, and they haven't been able to find a firm with somebody with the skills and expertise to be able to complete these financial statements. And this is in a very rural location. So that should be considered too.
Brooke, I got a question.
Absolutely.
That last county you mentioned, was it in Kansas?
Yes, all of them are in Kansas.
Okay, but you said it was GAP compliant, but it wasn't on the list.
No, I'm sorry, Commissioner Dorsey, it wasn't in the top 10 that I showed on the slides. I evaluated the top 20 most populous counties, but for the purposes of this presentation, I only included 10.
I thought only the top 4 were on GAP though.
Well, this one, the sample size that I selected, the statement hadn't been submitted to the state yet. So the financials aren't actually completed yet. And they're going to have to move to a cash basis because they cannot
Oh,
find
okay.
a firm to complete the work. Yeah. So they're working on their 2023 financials right now. They're going to have to catch up with their 2024 and go from there. So thank you for the question. With that being said, it is very important to note that the slides don't contain any of the information about what level of consulting would be required for implementation of the framework. I think Jerry and Brian touched on it, but staff did reach out to 4 firms that have experience with governmental audits and who have helped other organizations implement a GAP reporting framework. The agencies, all of them cited hundreds of hours of work with hourly rates ranging from $150 an hour up to $500 an hour, depending on the level of expertise of the staff assigned to the engagement. The cost associated with this work would likely reach into the hundreds of thousands of dollars. The cost of our annual statement or our annual independent audit would also increase significantly, if not double. But, like Jerry, I think said, once implementation takes place, some of those fees will naturally drop off as we, move into that framework. It just takes a little bit of time to get set up. Alternately, going into that return on investment, cost benefit analysis, staff reached out to our financial advisor and asked what they have been observing in the debt market with respect to interest costs when an organization has an AA1 rating versus a AAA rating. So right now, the county maintains an AA1 rating, which to me is a credit score of 800 versus a credit score of 820 with the AAA rating. So we have a very high rating, very reputable. The financial advisor informed that in the existing debt market, they're seeing a 0 to 5 basis point increase from the two ratings. So, it should also be noted that bond sales are competitive in nature. So basis points can vary pretty wildly depending on the market. Staff calculated the full future $55 million bond issue, assuming that we may take on more debt in 2033, plus debt that could be included in refunding if we did do that. And that would be $3.76 million left on the Treatment Recovery Center bond issue that we did back in 2022. I think that was a $10 million bond issue. Where the net interest cost is calculated at 5 basis points higher. So using the high end of what our financial advisor said they're observing, and came up with the annual savings over 20 years, which is listed on this slide. It looks like, if we did take on a little bit of additional debt in 2033, and we refunded existing debt, it could save $318,682, moving from an AA1 rating to a AAA rating. And I want to caveat that with the fact that if we go GAAP, it doesn't mean that we will get that AAA rating. Staff will strive for that, but it's not guaranteed. The cost to add finance staff were then subtracted from the interest savings to come up with a net return on investment. Should we adopt this method and add staff? But the technical expertise and range classifications for those positions are still undetermined. I don't know how close that $65,000 would be for staff with this level of technical expertise. So that may go up or go down depending on what we would need. If we hire a CPA, it's not required, but it would be desired. Yeah, those values would change.
Brooke, before we move off of that
Yeah.
slide, can I just, I'm
sure.
going to just have you probably reiterate some points you made. That 5-point basis swing, it might be 0, it might be 5. If it's 0, instead of looking at that 318,000, it would be 0 over 20 years. The annual expense would still be present.
Correct.
Okay. And then also, you're assuming that that's the AAA rating that comes from adding GAAP. That may happen or it may not happen. So that also, again, might be, a 0 increase. You're also talking about which debt are we talking about? Are we talking about, because if we were to initiate GAAP now, the next time we issue debt for bonds is 2033 is the kind of the next opportunity that we would have just based on our capacity. So when would that 20-year savings, if it were to be, when would that be occurring?
It can occur really in a number of ways. So this makes a lot of assumptions, and I just threw together some numbers based on what could happen. So we can refund the existing debt, so the new $55 million bond issue, after 8 years. So that's 2033. We can issue new debt in the meantime. So we're not limited from issuing. If we need to issue new debt, we can issue new debt. We just can't do anything with this particular debt that we're issuing until 2033. So, the savings can come in many ways, and, based on whether or not we need to debt projects or whether or not we can pay cash really will be instrumental in kind of figuring out how this will be calculated out, 20 years out. So if we're going to issue debt in 3 years, I would be grateful to know that so I could better come up with a cost benefit analysis if I knew how much and I could see that.
But Brooke, this 318,682 is based off of a debt's 5 basis points on a $55 million debt.
Correct,
agreement
correct.
Right now.
Yes.
So, which we can't do
No,
because
we
we're going to
can't.
issue that debt this year and we're not GAP. And we do
Correct.
not, I want to be very clear, we do not have capacity for an additional $55 million in debt. So even if we, so it would be, so, and really this is, these are not apples and oranges, if that's what you're trying. I want to be very clear with the committee.
Our bond guy said currently there is no difference either between
Right.
AAA and AA+.
This is this would be a very big swing but our current, what we've been told by our financial advisors, there's no difference. in
No.
that right now.
Yeah.
And I appreciate that. I just wanted to kind of go through like the what ifs that are included in this scenario are not actually available to us at the moment.
Agreed.
No,
agreed.
yes,
Thank you for
this is
making that
big,
clear.
like if we were GAP today and we, this would maybe mean a little bit more, but yes. So thank you.
Fair to say it's a picture of what could be a best case scenario.
Yeah.
If all those things lined up.
If we went back in time 3 years.
Correct, right.
Yeah.
Yes.
But if all those things lined up and we were having this conversation previous, then that best case scenario, we're looking at less than $50,000 return on investment as far as your rough estimates go.
You've got it.
Thanks.
Yeah. So commissioners, Jerry and Brian touched on some of the GASB gap, as they stated it. The Governmental Accounting Standards Board, this acronym gets me every time. I'll get it right. The Governmental Accounting Standards Board, or GASB, was established in 1984, like Jerry said, with the introduction of Pronouncement 1. Since that time, GASB's introduced 103 additional pronouncements as a framework for how local governments prepare their financial statements in accordance with the GAP framework. In other words, it's a technical guide for how financial statements should be prepared. In the research that staff performed for this session, the GASB statements that were brought up time and time again by individual firms or peer organizations are listed on the slide. The first is GASB 34. This pronouncement would require the county to maintain a capital asset listing for all in-service assets in which the value of that asset is above a county determined threshold. Currently, the county has workflows designed such that if certain commodity or capital codes are used in the chart of accounts, the purchase gets flagged automatically. The county's threshold is $5,000. So if you use a capital line in the 80,000 series, it automatically gets flagged in the fixed assets model, and then an administration staff reviews that transaction, looks at what was purchased, and marks the equipment or the capital item as in service. The county does maintain a list right now of over 1,000 unique assets, but we do not depreciate them. For this reason, the county would likely need to hire a consultant with expertise in capital asset valuation. I don't know how to value a bridge that was built in 1942. And this does mean all in-service assets, roads, bridges, everything.
And this is an interesting this is where I think it gets interesting from our perspective, because we don't depreciate that bridge asset. So we don't say, hey, in 1946, it cost $10,000 and then each year the value of it goes down. But what we do is we do plan for its replacement in current dollars. So I actually find that far more valuable than a depreciation schedule, because what that cost 20 years ago to build and to depreciate, you still have to fund that depreciation schedule. And that's what we've done. So I don't want it to make it, I mean, I think it's important for us and for the commission to understand that we are more focused on what will the cost of that bridge be when we need to replace it, and how are we preparing for that replacement?
Absolutely. Thank you, Sarah. The next is GASB 54, and this is related to the classification of fund balances into non-spendable, restricted, committed, assigned, and unassigned. This would help determine the county's net position. GASB 68 amends another statement and establishes standards for measuring and recognizing liabilities, deferred outflows of resources, deferred inflows of resources, and expense or expenditures related to pension plans. So this is commonly referred to as pension liability under CAPERS, and it is very specific to the state of CAPERS is specific to the state of Kansas. GASB 75 implements the requirement for an actuarial report for other post-employment benefits, or OPEB. CAPERS does provide an actuary report for the pension and death and disability plan report. The county would be required to complete an actuary report for the OPEB on the benefits liability related to Douglas County retiree health insurance. So implementation of the report would likely require a consulting firm and an actuary. They'll possess the skills that are necessary to create that report. GASB 87 requires financial statement to include lease resources, inflows, and liability outflows for the reporting agency. So this county staff actually did identify all leases at the implementation of this pronouncement. Any leases that have been determined by our independent auditor to be material are noted in a footnote on our financial statement. Similarly, GASB number 96 implements tracking of intangible assets related to IT subscription-based information technology arrangements. If you have any questions about this one, I might tee it off to Jerry and Brian because it's a lot, and I'm still wrapping my head around what that is. And I had to pull in some staff from IT to help with that last year so that we could also include information about those SBITAs in our footnote. So we have already started the work on that as well. You know, Commissioners, another thing that I think is worth noting here is that, you know, we have component units that are on our financial statement. So this includes Lawrence Douglas County Public Health and the Extension Council, Douglas County Free Fair. These folks would all be required to convert to the GAAP reporting framework. So this would potentially have an effect on their staffing needs as well.
I got a question. Out of the 18 community partners currently, how many are already on GAAP?
I don't have that answer for you.
Most community partners don't have access to regulatory or accounting. So I don't know what kind of financial statements, if you're talking about GAAP versus regulatory, my assumption is they do some sort of accrual or liability basis. Because our method of regulatory accounting is only available to local governments.
Yeah, I can confirm that through the SEC, it's mandated that all publicly traded companies, there is a GAAP requirement for that. I don't have that information for nonprofits or 501c3s. Sorry, but I can get that for you if you'd like.
We actually have a lot of them that just do 990s and give them to us too. So their financial statements are very different than ours. Brooke, we've got about 5 minutes here,
yep.
so we need to wrap up.
Actually, so that was my last point. Thank you, Sarah, for redirecting me. Commissioners, you know, staff is really interested in hearing what your goals are for achieving this GAAP reporting framework. So I'm going to go ahead and stop sharing my screen. We've still got our Eide Bailly team on the line too, if you guys have specific questions, but staff is really looking for direction on whether or not commission, you know, wants us to continue this study and how we move forward from here.
When we did our compensation study a while back, I think we used 14 peer municipalities or counties, and all of those are using GAP except for Riley and Leavenworth. So that's 86% of our peer groups are already using it, and we're not.
And Commissioner, we really changed that up depending on which comparable counties we use for depending on which particular analysis we're using it. For in that particular case, those were comparable counties in terms of who we attract and recruit from and who have similar type of work product.
Real quickly, I want to jump in because I think they wanted me to be the historian. We've had this conversation before in about 2008, 2009, when we started to go to an ERP. The treasurer at the time, Paula Gilchrist, and I, we did it, and the county did an RFP for an auditor, and we made the decision to go to GAP. That lasted a year, and the auditor fired us. They said we didn't have the resources, the departments, the personnel. They were losing money on us, and there was no way for us to get there unless we hired a whole bunch of people. Especially, they said we should have a CPA on staff. So then we went back to RFP, and we specifically asked the question, should we go to GAP or our current system? Everybody that put in an RFP told us it did not make sense for return on investment. So that's why we made the decision to stop moving towards GAP and go to what we've got right now. And the largest part of it is what you heard here was we would have to add so many resources. And at that time, we felt that it just didn't provide enough of a return on investment. So that's kind of how we got to this point. Did that sum it up?
Yep.
Yeah.
What was the budget back then?
I think we're probably about 125 million,
Yeah.
130. So we're at like 198 now. But the real thing, because we do not run a utility, so we don't have an enterprise fund. So that's also the difference between a governmental fund account and a different type of, we don't run a utility that has those types of difficult transactions that also then therefore require a lot of debt issuance. When you look at our books, they're relatively simply straightforward type of financial positions. I think our only fee for service fund is the motor vehicle fund. The rest of that, we do not have fee for service funds. So it's a pretty simple, so KMEG is really built for those types of things.
And I think you saw that we sit in this weird spot. We're not a medium-sized county. We're not a large-sized county. We're kind of this in-between. And anytime we go to RFP and stuff, they're always, we're not big enough for some things. We're too small. We're not small enough. And I think we ran into that with this also. We got scared when they talked about all the resources we would have to put in place. I think we could continue to work towards certain things on that, but just recognizing moving to that adds a lot of resources.
So Shawnee County is the next size up, but also in GAP. But don't they also issue a lot more debt than Douglas County does?
Thank you for the question, Commissioner. So Shawnee County, I looked at their 2025 debt on their schedule of indebtedness on their budget. They have $58.5 million in debt issued, and they levy $111 million in taxes.
And prior to our new debt issuance, our bond rate, our debt issuance has been quite low.
What's our current one?
About 14 to 19 million is where I've generally seen it.
It feels different to me like this might be a conversation that we do keep coming back to. I'm glad for us to have it. But it seems like the timing would be smarter looking prior to like 2033, if that's the next time that we're looking to issue significant bonds, or potentially, I mean, that we would have the capacity to initiate additional bonds. Right now, I don't see that we gain anything other than the headaches with it. To me, I always appreciate a cash basis reporting. It's easier for me to understand. I've worked with organizations that have done accrual accounting, but I think it's more accessible, I think, to talk about cash. I think it's easier for us to explain, easier for people to take in. That's my personal preference there. I guess I'd also be curious to hear what our treasurer and clerk think about kind of how this impacts your work, either one of these systems.
It's a big impact on Adam's operation.
It is a big impact, and we kind of looked at it, and it's really restructuring how we're doing basically everything we're currently doing. Taxes that we have not collected then go to liabilities. We're drawing down from that. I think Johnson County, we looked at it, how they do it. They're hitting their system 3 to 4 times from collecting the taxes through distribution. So right now we might hit it twice, putting it into revenues, into those tax, and then pulling it out for distribution. So that's pretty simple for us right now. But when you talk about holding it as a liability, drawing it down, putting it into account, Johnson County has a pretty long process for that. So it does complicate things. I don't know what it'll do to staff. I don't know what we will have to add if we add any. So I think that's something that we have to continue to look at, of how much more work or is it going to take to do a simple cash receipt. Everything's going to have to be put in on the front end, and then we take it in from there. So it'll take some work. It's still kind of exploring.
Adam, I got a question.
Yeah.
When you issue currently a CD, and let's say, for example, it matures in July and it's a 5.5% interest rate, when do you put that interest on the books? In July?
We put it the day we get it in. We put it on the books.
So we don't
see
know that
interest.
money's coming until then.
Correct.
It's not booked in our financials. We do know it's coming. So I think but it's not booked in the financial system as an accounts receivable. But
So who knows it's coming?
well,
I know it's coming.
Adam knows it's coming.
So we have so we have the financial system, and then we have an investment system. So the investment system will track when all those CDs mature.
Yeah.
And then when they mature, then we get that money from the bank, then we put it into our financial system. So they can talk, but since we don't have, GAAP, we don't need to put the investment stuff in there saying, hey, we're getting $10 million in July. We don't have to do that. So I feel like it would complicate things with the way we currently have it set up. So they're kind of separated right now. So we have an idea of what's coming in, but it's not hitting that financial system.
And then when I sit down with the treasurer to develop the proposed budget, we review that information together and review his actuals received. And then we collaborate together to make an estimate for budget.
Real quick, it would change our processes quite a bit, especially when you look at assets, when you look at the accruals and so forth, but how we track assets, the assets we are tracking gets really large. When we kind of got scared, we didn't have the ERP. So we do have the ERP. The ERP is there and would help us in a lot of different ways. But we'd have to restructure all of our processes and policies. So it would take a while. So if we did make the decision, it's a couple-year process.
And I'd say, I do think there's more things that we've done over the last couple of years through the financial system where I feel like we've implemented some GAAP standard practices. Like I said, we still have a fixed asset list. We just don't depreciate. We do maintain payroll liabilities, and we charge back against those in year end. So I think we do have some footnotes in our statements that are kind of what I would call, a little bit GAAP adjacent, in terms of they're not a full compliant statement, but they're we have done some of those things where they made sense. We did post-employment benefit actuarial study for a long, long time. And actually our auditors advised that we didn't need to do it anymore. That it, wasn't particularly helpful from that perspective of what our potential share of the CAPERS liability is. We are fully paid up on our CAPERS. It's the state that has underfunded their CAPERS portion of the liability. So, that wasn't a helpful part of our statements.
I think this raises two questions. Is the county going to get bigger or stay the same? If it's going to get bigger, then it's probably more economical to start a process of changing than to wait 5 years because everything's going to cost more. If we're going to stay the same, then maybe there's no point in changing. But if we're ever going to change, it seems to me it should be tied in to looking at the new accounting system that you're going to look at, because you don't want to buy something 3 years from now that's not going to work 5 years from now.
All ERPs now have the capacity to do GAAP. I don't think there's any vendor out there that provides something that doesn't have GAAP. So we would be able to use it.
Current system is GAAP.
Yeah, our current system allows it also. And we use some of those functions, like encumbering funds and so forth, to help us on kind of predicting the cash we need each week. So we do some of those processes, maybe not in as formal of a process.
If we were to be looking at a particular threshold, is there a threshold that you have in mind? So I know that, Commissioner, you mentioned 2030, right? But if there was a threshold between now and 2030, is there a particular threshold you'd have in mind?
If I may, staff, if commissioners signal today that you would like staff to continue studying this and potential costs related to a GAAP implementation, then we, oh my gosh, I'm sorry. I just totally lost it. What was your question again, Commissioner? I'm so sorry.
Around a threshold, yeah. So
The
yeah, Commissioner
threshold.
mentioned 2030, right? And so
Okay,
if we're
yes.
still thinking
I'm
around
sorry.
this, right, is there a threshold that you might
Yeah.
consider?
Thank you for asking
Yeah.
your question again. I'm sorry.
Sorry.
My hope is that we would align this with implementation of a new ERP system. So if staff hears from commission today that you'd like us to continue studying and going down this path, we would really like to align this, not with necessarily like we're going to go out to bond sale in 2033 or, if that's the goal, the staff's goal would be to implement seamlessly with the implementation of our ERP system. That would be the hope. So does that answer your question, Commissioner? Okay, great. Thank you.
I think the budget items you have are pretty soft now because you didn't include anything for training, unless that would be under the consultant, because you go converting, you're going to have to train people.
No,
Yeah.
that's definitely the costs that are shown here are just what I would say very preliminary to give commissioners a sense of where we would head. We would need to plan for implementation, consulting help to help with that, and training for staff. So I would anticipate the cost going up from there.
For no likely return on investment in the near future, if we're not going out for another bond sale, even if we are, it may or may not have any return on investment. So we may or may not have a difference in basis point, and we may or may not go from a AA plus to AAA. So there's a lot of what ifs there to add staff and spend that money.
I'm not sure you want to look at it as a return on investment, though. I think it's more just a statement of financials in a transparent way that business people can understand, and the economic development of the county might improve if we had GAAP things to look at compared to all the surrounding counties who use it.
I have a question for Jerry. Jerry, this is Commissioner Kelly. You
Yes,
mentioned
Commissioner.
earlier that it gives you a longer term view of your budget, of the sustainability of your government. My experience being on the county commission is I go 1 year at a time because I have no idea what we're I mean, we have projections for what we're collecting for sales tax. It'd be great if we had a crystal ball to be able to tell us exactly where property valuations would be, but we don't. So can you give me more of a picture of how in our role in setting a budget, we might like to have a longer term view? Like walk me through your thinking there.
Yes, thank you, Commissioner. As you mentioned the word budget, budget typically is a very short-term focus. At most, it's usually just 1 year. So when you all make decisions that are short-term focused, based on the budget, you really don't have all the information available to you to decide whether your overall net position could handle, say, for instance, the level of bond issuance that you're going to issue in 2033. So, for instance, all of your pension liability, your OPEB liability, your long-term compensated absences liability, every bit of that is only in your note disclosure. It is not a liability on the face of your financials. So when you are thinking longer term for, let's say you decide to give your employees a 3% raise, that impacts your long-term benefits as well. And so because of that, well, I will assume that impacts your long-term benefits, including pension, et cetera. So that short-term decision, you don't know how that's going to impact 20, 25, 30 years from now. And you will not see that in the current framework that you use now. With a GAAP basis and full GAAP, you can see the impact that decision makes on the long-term fiscal health of the government, because you're able to see all of the impact on your net position, the OPEB, the pension, the compensated absences, all those long-term liabilities are on the face of the financials, and that directly impacts that overall net position. The only impact you have on governmental funds is just, again, what happens in the short term. It's only going to be at that government-wide level that you actually can see the longer-term picture. Hopefully, Commissioner, that answers your question.
It does. I was sort of expecting you to say more about, long-term debt around, if we had a utility or something like that. Like I can see it being used in that case. I hadn't really thought of it in terms of long-term liabilities, like absences and like paid absences and things like that.
Mhm.
I would, since staff is asking for our feedback on it, I think in some of the things I'm hearing, there are maybe some things that we need to articulate a little clearer. And I'd like this new commission to go through the budget process and sort of walk through and determine where, because that's where we need this financial information specifically, and go through that budget process and identify. The conversation we just had about investments, I think, was eye-opening to me. Like, is there a better way? Is there another way of reporting investments that's a little clearer than what we get now beyond a footnote? Maybe on the first day of budget, when we talk about revenue, we start thinking about that revenue. I believe that staff looks at that and makes their recommendation based on that. But maybe there's without going to GAAP and taking on that large cost that we're talking about, I'd like to continue to think about how the answer to this question, because I think what I'm hearing, one thing I'm hearing articulating is other counties do it differently, and so we should do it. I've been part of a nonprofit, a community partner, as a matter of fact, that does GAAP accounting, and I found it incredibly confusing, especially when we would talk about depreciation of assets. because every time they told us where our cash position was, they would have to say, it's not really what it says here. Don't freak out. That's not what it is, because they had worked the depreciation into it. So it became a little bit of like, I don't even understand what I'm looking at here. So I'm not sure it helps us be clear, but I want to keep, we've never had this discussion since I've been on the commission. And I'd like to keep this discussion in mind as we go through another budget cycle. And then before I answer this question about what our goal is here, I hadn't considered a lot of these things before when we do our budget process. And that's the most important thing to me about setting. It may be short term in Jerry's rule, right? But I do think, we do have to have an eye for the future, but I also think we have to think about what are the services and needs we have as a community right now. And that's where I think our cash basis really works well.
Also worked with a lot of nonprofits and all different kinds of accounting methods, accrual to cash, modified cash, et cetera. The ones that are working in accrual, and they're small enough, they're not, full gap necessarily, but they're working in an accrual system, then there'd be this shadow report of what's actually going on with cash, so that as a decision-making tool. So in terms of the transparency of it, we as a board have had some conversations about what is most transparent and what is most understandable, and being like, we need to better communicate our budget and our finances to people, but that's not necessarily that. We are fully transparent with it, in that there's this massive document that anybody can have access to, and we have much of it online. That's not the issue so much as translating it into something that is accessible to people. And I think that in the way that we as commissioners interact with our finances, I think that's part of the discussion we're having here too, is do we need more schedules that are available, or do we need more accessible, do we put our budget in accessible ways that people can understand, that we can communicate to them? So that's not necessarily making a decision or moving forward in any way. I just want to recognize that more is not always better.
Commissioners, I also want to add too that in the state of Kansas, it's required by law that staff come before you each year and present you with a gap waiver. So we will have an opportunity to speak about this every year. And, from a reporting standpoint, staff is very committed to giving commission detailed reporting should you guys need any sort of report. So we're in fact working on a quarterly report to be able to provide to you guys, so that you can get a snapshot of those periods where transactions are occurring. So I just wanted to throw that out there, that this is an annual conversation, and staff will be coming back in January with that waiver.
Well, it's an annual conversation. If we wanted to change, it's probably a multi-year event. And to me, it would make sense, if we're going to consider changing, to do it in line with the new ERP system.
This Commissioner Reed, I'll just share, well, first, I would agree that if a majority of the commission is in favor of transitioning to GAP, that sooner rather than later, and in alignment with the EAP process, does make sense to me. Right now, with the information that I've received, which has been really helpful to better understand the differences and unpack it some, I am struggling to see what the benefit would be. It feels like the only tangible reason is because most people do it, or most governments do it. And I mean, that kind of depends on what sample size you're looking at too. So in Kansas, most don't. We are, the 5th largest and the 101st smallest, I guess is another way. So we are in that weird position. But the other 4 counties that are larger than us doing it doesn't feel like a compelling enough reason. It doesn't necessarily seem to be tied to the amount of tax authority and budget per se. And so right now I'm really struggling to see the benefit, but the piece of information I would like to understand a little bit more in a follow-up in some way. To piggyback off of Commissioner Kelly's point, I'm interested in understanding a little bit more from staff's perspective, maybe what their answer to Commissioner Kelly's question, a little bit about the how this might help us look at the long-term picture. I'm curious how it is that staff currently are looking at those long-term things, the long-term liabilities. I'm thinking about the employment benefits fund, for example, and the sort of projections and calculations that you're doing annually to figure out what those long-term liabilities might be, even if they aren't reflected in the financial statement as we currently prepare it. And then similar to that conversation that we had about the knowing that the interest is coming based on the decisions you've made for the deposit in such and such account, but not recording it in financials until it comes. So what I'm hearing is that there are absolutely processes in which staff are thinking about long-term budgeting. We talk about it in relation to our CIP regularly. I think there's a lot of examples of that that just maybe aren't reflected in how the financial report is prepared and audited and recorded. So I'd be interested to hear a little bit more feedback from staff at a later date. I know we are running out of time here quickly, but to understand how it is that your current practice of looking at those things are, even if it's not recorded on the financial statement itself. Does that make sense? I'm seeing some affirmative head nods. Okay.
Yes, thank you.
Lastly, I just want to mention that I'm interested in how this would affect the community partners that we partner with, if they currently are GAP, if they're not GAP, just so that we'd have a better understanding if we determine going to GAP, how that would truly impact them financially or just their business operations overall. Thank you.
Commissioner, can I clarify? Are you talking about those partners that fall under our audit? So the Extension Council and Public Health, you're not talking about like all of our community partners that have their own
Correct.
separate
The ones that
financial-
fall under the audit. Thank you for the clarification.
Okay, as Commissioner Reed mentioned, we're getting towards the time boundary here. We're probably actually past it. But I wanted to check with staff to make sure you've gotten the feedback that you were hoping for.
Yes, commissioners.
Yeah, I think we can bring you some additional information. I am still going to want a little more clarity of how much more study you want us to do, but we can talk about that at a later point.
Okay.
Because I don't know that I have clear consensus on that.
Great. Well, with that lack of clarity, we will still adjourn and we will continue the conversation. We'll meet again at 5:30.